How would GST be processed on cash and credit purchases? Well, let's refresh what we know about GST. GST clearing is the name of the account, and we assume it's a big tank or big tub of liabilities. So it follows the rules of debits and credits of a liability. And what happens is, every time as a business we receive GST or charge GST from our customers, so for example here we've charged $10,000 of GST on our cash sales and credit sales, the tank of liabilities here goes up. So that would be a credit into the GST clearing account because liabilities go up on the credit side. However, we get to offset that or reduce it by every time as a business we pay GST or get charged GST by our suppliers. So that could be for things like rent, insurance, or buying inventory. And in this example, we've been charged $8,000 of GST. So that is going to reduce our liability in this case from $10,000, so the water level is going to go down to $2,000. And when liabilities go down, that's a debit. So we just need to refresh our memory now what things do and don't have GST. So in our course, these things do have 10% GST on them, or the expenses, except for those that we'll put over here in a second. When we buy inventory, when we buy non-current assets, and purchase returns to suppliers. The things that we don't have GST on in our course are all these things here, and we'll deal with them later because this video is just about the things on the left here. And we're going to apply our rules of debit and credit. So there's our sort of acronym there, LONRE, so that's the order we're remembering them, or if you want to change it around to a loaner, there it is there, but it doesn't really matter too much because we're mainly dealing with liabilities here, and we've got that second in either system. So, what are the main payments and purchases we'll need to deal with GST for? Well, here's our list here for payments, expenses, and liabilities, these things here. What we'll do right now is we'll cross out purchase returns to suppliers because we don't know what that is yet. We'll deal with that later. So what we're going to do now is break down these things here into two groups and say, basically we can divide all these things and say each thing is either a cash purchase or a credit purchase. And there's four things in particular we'll need to deal with. The first one is, let's deal with the cash purchases. There's going to be cash payments of expenses. The second thing we'll deal with is cash purchase of inventory. The third thing is cash purchase of non-current assets, which we'll abbreviate to NCAs. And then with credit purchases, the only one we need to deal with in our course is credit purchase of inventory. In the real world, we might buy other things on credit besides inventory, but in our course, it's just inventory. So that's the only one we'll worry about. Let's go through them one by one. So let's take the first one, cash payment of expenses. So let's say on the 1st of March, there was a cash payment of $4,000 for rent plus GST. So before we do all this, just remember, here's the supplier. So in this case, it's a landlord. Here's our business. We're renting a property from this supplier. And they'll actually charge us two things. So in this case, it'll be $4,000 for the product, which in this case is rent. But there'll also be $400 for the GST. So when they charge us, we're going to have to pay them $4,000 plus $400. We'll have to pay a total of $4,400. So when we think about that, we're actually paying for two things, the product and the GST, and that's going to be important. So let's deal with that. So the first thing I'm going to deal with is with our debits and credits. There's an account called rent when we pay for rent. It's an expense and it's going up. When an expense goes up, that's a debit. We've also got GST clearing. We assume that's a liability. And in this case, we learned just a second earlier that when we pay GST, our liability goes down. So when the liability goes down, that would be a debit. And lastly, we've paid cash. Cash is an asset, and it's going down. And when an asset goes down, that's a credit, and it will go down for $4,400 because, like we said, we're actually paying for two things. We're paying for the rent and the GST. We should always check whether that balances in the accounting equation, so let's just take it one line at a time. The rent is an expense, so expenses make owner's equity go down, $4,000. The GST clearing is a liability going down, so that would go down here. And then cash is an asset going down, $4,400 there. And that actually balances. We've got assets going down, $4,400, equals liabilities going down, $400, and owner's equity going down, $4,000. So $4,000 plus $400 equals $4,400. Beautiful. So now we put that in some ledgers. So we're going to need a rent ledger, a GST clearing ledger, and a cash ledger. You might call this bank, cash at bank, whatever, it's the same thing. So we're just going to call it cash here. Let's take the first one. Rent should be a debit on the 1st of March. So I'll do the date and the amount. As always, I'm going to leave the cross-reference till last. You do whatever system works for you, but that's just how I do it. I'm going to go to GST clearing, and I'm going to do a debit on the 1st of March for $400. 1st of March, debit, $400. Then I'm going to go to cash and I'm going to do a credit on the 1st of March for 4,400. So we've got 1st of March, credit 4,400. Now I put the references in. So in rent, I'm doing a debit and I'm saying where is the matching credit for this? It is in an account called cash. So I'm going to write cash there. Likewise, I'm going to do the same for GST. That's the debit. Where would I find the credit? Here. And then cash, I'm going to do a double reference because here it's 4,400. It's referencing the rent account here and the GST clearing account. So I write rent/GST clearing. Done. That's how we process a cash payment of expenses. We did rent. It could be anything, any other expense that has GST. Transaction number 2. What about if I buy inventory with cash? So on the 2nd of March, cash purchase of inventory for $9,000 plus $900 GST. First thing I got is some inventory. Inventory is an asset. It's going up. When an asset goes up, that's a debit. So the inventory will be $9,000. I'm also being charged some GST. GST clearing is the account. That's a liability. And when I get charged GST, that's going down. So when a liability decreases, that's a debit. And lastly, I'm paying cash. Cash is an asset. It's going down. When an asset goes down, that's a credit. And it will be for $9,900 because I'm buying two things. I'm buying inventory and GST. So let's just check our accounting equation works. We've got an asset going up called inventory 9,000. I've got my GST going down 900 here. So that's a liability decreasing. And then I've got cash, which is an asset going down 9,900 here. So if we just add all that up, so nothing's happened to owner's equity. So assets went up 9,000, but down 9,900. So that's a total of it went down 900. Liabilities went down 900, and nothing happened to owner's equity. So we can see negative 900 plus 0 equals negative 900. Beautiful. Let's put that in the ledgers. So we're going to need an inventory ledger, a GST clearing ledger, and a cash ledger. First one, inventory debit 9,000 on the 2nd of March. So I've got the date, and I'll put 9,000. Then I've got GST clearing. I'm going to do a debit for 900 on the 2nd of March. 2nd of March, debit 900. And lastly, I'm going to do cash. Credit on the 2nd of March, 9,900. Put my references in. So here's the debit and inventory. I will find the matching credit down here in a ledger called cash. So I'm going to write cash there. GST clearing, same thing. Where will I find the credit? It's in cash. And in cash, I'll do my double reference again because it's a credit here for 9,900. It's actually referencing two things, the inventory and the GST clearing account. So I'll write inventory/GST clearing. Done. Transaction number 3, a cash purchase of a non-current asset. So I'm going to use the example of a vehicle. It could be fixtures and fittings, or it could be computers, anything. Anything that's a non-current asset, which we abbreviate to NCAs. 3rd of March, cash purchase of vehicle for $50,000 plus $5,000 GST. First thing I've got is a vehicle. That's an asset, and it's going up. So when assets go up, that's a debit. I've got GST clearing. That's a liability. Whenever I pay GST, that liability goes down. So that would be a debit for $5,000. Lastly, I pay cash. Cash is an asset. It's going up, down. And when an asset goes down, that's a credit. And my debits match my credits. Just check our accounting equation there. I've got a new asset called vehicle. It's increasing 50,000. I've got a liability called GST clearing going down for 5,000. And then I've got cash, which is an asset going down 55,000. So let's just balance this up. Assets went up 50,000, but down 55,000. So all up, they went down 5,000. Liabilities went down 5,000, and nothing happened to owner's equity. So negative 5,000 plus 0 equals negative 5,000. Beautiful. All balances. And then let's do our ledgers. We're going to need a vehicle ledger, a GST clearing ledger, and a cash ledger. So the first one was vehicles, debit, on the 3rd of March. So we do 3rd of March, debit 50,000. Let's go to GST clearing. Let's do a debit of 5,000 on the 3rd of March there. And then cash, we're going to do a credit on the 3rd of March for 55,000 there. Let's do our references. Vehicle, there's the debit. I will find the credit to that in cash down here. So I'm going to write cash as my reference. GST clearing, I'm going to write my reference as cash as well because that's where the credit is. And in cash, I'm going to do a double reference because there's one credit here for 55,000 and it references these two things, vehicles for 50, GST clearing for 5, so I write vehicles/GST clearing. So that was pretty repetitive, and that's because we could probably compare these, right? And go, anytime I pay cash for an expense or an asset. So I've got an expense here, I've got a current asset here and a non-current asset, but it's kind of the same every time. What happened was, whatever the expense or asset was, we did a debit to that account. So when we had rent, it was a debit and the reference was cash. Debit, reference was cash. Debit, reference was cash. So that's the same every time. Then with the GST clearing, because we paid GST, that was a debit with a reference to cash. Debit, reference to cash. Debit, reference to cash. So that was the same every time. Obviously the amounts are different, but we're just worrying about the debits and credits now. Same thing. And then lastly, with the cash at bank, every time when we paid something, cash went down. So that was a credit, credit, credit. It's just the reference that changes. So in each time we're referencing two things, something and GST clearing. So in this case, it was rent / GST clearing. In this case, it was inventory / GST clearing. And in this one, it was vehicles / GST clearing. So obviously, it could be any expense or asset that we have to buy, but the important thing is here, when it's a cash payment or a cash purchase, the debits and credits are going to be the same. It's just the names of the accounts and the amounts that are different. Let's just deal with our final one, which was number 4. I buy inventory, but instead of cash, I buy it on credit. So we got the 4th of March, credit purchase of inventory for $7,000 plus GST. First thing I've got is inventory. Inventory is an asset, and I've got more of it, so it's going up. So that would be a debit of $7,000. Again, I'm being charged GST, and even though I haven't paid it, like with the other ones, I'd paid it, but in this case, I've just been charged it, but it doesn't matter. We assume that's a liability. And when we get charged GST, that liability goes down. So that would be a debit. And this is where the main difference is, because last time this was going to be cash. We're going to do a credit to cash because cash went down. But in this case, it's a credit purchase. And what we call that is when we buy inventory on credit, we call that accounts payable. Accounts payable is a liability, and that liability is going up. So when a liability goes up, that's a credit, and it will be for $7,700 because we will owe this accounts payable for not only the inventory, but also the GST. So it has to equal the total of these two numbers here. Let's just check our accounting equation. Let's start with the first thing. Inventory is an asset, and it went up. So that's here. GST clearing is a liability, and that went down here. And then this liability called accounts payable went up $7,700 there. Nothing happened to owner's equity. So let's balance it out. Assets went up $7,000. Liabilities went down $700, but up $7,700. So if you add all that up, it went up $7,000, and owner's equity was 0. So liabilities up $7,000 plus 0 equals assets, which went up $7,000, and it balances. Got to put that in ledgers now. So we're going to need 3 ledgers: an inventory ledger, GST clearing ledger, and an accounts payable ledger. So let's take it one at a time. We've got inventory as a debit on the 4th of March for $7,000. So we do 4th of March, debit $7,000. GST clearing is a liability, which is a debit on the 4th of March here. And then lastly, accounts payable is a credit on the 4th of March for $7,700. So we're just going to do our references. So in the inventory account, this time the cross-reference, last time it was cash when I paid for cash, but it's not going to be that this time because that's the debit there. Where's the credit? It's down here in blue. That's in an account called accounts payable. So I'm going to write accounts payable there. Likewise with GST clearing, I'm going to write my reference here as accounts payable. In accounts payable, I'm going to write, there's the credit of $7,700. The 2 debits are in an in a ledger called inventory, and GST clearing there. And that's how we process the GST on a credit purchase of inventory. So if we could just summarize that and go, well, how is that similar? Situation number 2 was we bought inventory for cash. Situation number 4 was we bought it on credit. Well, it's pretty similar. We had the inventory account going up. So that was a debit on both. What you can just see is it's slightly different, the reference. So when we buy in cash, the reference in inventory will be cash. When we buy on credit, the reference will be accounts payable. Likewise with GST, it was the same thing. It was a debit both times. It's just the reference that is different. So when we bought for cash, the reference in GST clearing was cash. When we bought on credit, the reference in GST clearing was accounts payable. And here's the main difference. So it's actually the account is different. When we paid with cash, this ledger here was cash. When we bought on credit, this ledger here was accounts payable. It was a credit in both accounts. Now the reference will be the same. It will be inventory / GST clearing. Inventory / GST clearing. It's just that it is a different ledger because in this case we bought with cash, so an asset went down, And in this case, we bought on credit, so a liability went up.